China is imploding. I mean, Evergrande, yeah, they technically filed for bankruptcy, but they were bankrupt 2 years ago. Everyone could see that coming. Everyone knew what the impact would be. The housing market has been crashing for the better part of 2 years. The Chinese people, everyday people, even if you have a good job and have some savings, they can't invest in that much. They can't invest in Western stocks because of capital controls. They can only take, I think, $50,000 a year out of the country. There are workarounds and there's money laundering and all that, but basically, it's very difficult for the Chinese to invest in anything except Chinese stocks and Chinese real estate. But they've both been crashing. Chinese real estate's been crashing for a while. It's going to get worse. Now the banks are going to be in distress because they lent all the money to all the properties that are going bankrupt. And then the Chinese stock market has been crashing. It's down over 10%, I think closer to 15% in the past month.
In this exclusive update, renowned economist Jim Rickards provides a critical analysis of the current state of the Chinese economy. Backed by compelling data, Rickards reveals that China's housing market has been in decline for 2 years, with Evergrande's bankruptcy exacerbating the situation. The Chinese people face limited investment options due to capital controls, and both Chinese stocks and real estate are witnessing significant downturns. Rickards sheds light on China's declining stock market, down over 10%, and emphasizes the distress looming over Chinese banks as properties face bankruptcy. He also highlights China's strategic sale of U.S. Treasury securities, attributing it not to a desire to exit the dollar, but to address a severe global dollar shortage. With Rickards predicting a deflationary trend in China, a recession in Europe, and the U.S. relying on massive fiscal spending to prop up GDP, he raises critical questions about the sustainability of current economic policies. Stay informed on global financial trends, like share, subscribe, and hit the notification bell for more insights.
So what do you do with your savings? Well, you put it in a bank. These wealth management products are failing. They're kind of like junk bonds. They were sold as equivalent of bank deposits, but they're not bank deposits. They're not guaranteed. They're not protected. The money was used to invest in a lot of these crazy real estate projects that we just talked about. And so they're failing as well. World trade is contracting. That rarely happens, even in a recession. World trade kind of keeps its head above water, but it is contracting, something last seen on a large scale during the Great Depression. The U.S. is putting a lot of technological controls on Chinese exports and not allowing China to import some of the any of the high-tech semiconductor equipment or chips. The Trump tariffs are still in place. Biden made a big deal about undoing everything Trump did. Well, he certainly did that at the at the Texas border, the southern border of the United States, but he did not remove the Trump tariffs. They're still in place. Chinese holdings of U.S. Treasury securities are declining. The Treasury has something called the U.S. Treasury has something called the Tick Report. It comes out the monthly, quarterly, I believe it's monthly, but it shows changes in foreign holdings of U.S. Treasury securities, among other things. And China's are declining. So a lot of people, a lot of analysts look at that, particularly Wall Street analysts, and they go, aha, China's dumping the dollar, they're getting out of dollars, they're selling their treasuries, et cetera, et cetera. That's not why they're doing it. They are selling treasuries, but they're selling treasuries not because they want to get out of them. There's a serious global dollar shortage. They're selling treasuries to raise dollars to finance their own banks, which have a lot of dollar-denominated loans that are going into default. That where sort of goes from the central bank to the commercial banks to the to Chinese corporations, state-owned enterprises, et cetera. They're all connected. It's all controlled by the state. But the reason they're selling their treasuries, and they are, I mean, that's empirically correct, it's not because they want to dump them. It's quite the opposite. They wish they had more, but they need the dollars because there's a dollar shortage and a collateral shortage going on. So that's another sign of acute economic distress. So I look at China. The only way they keep their economy going at all is with infrastructure spending. And I've been to China many times. I've been not just Beijing and Shanghai, but I've been in Wuhan, Xi'an, and Chongqing, and Yangtze River, and a lot of other parts of the country. Um, they do these infrastructure projects that are amazing. I mean, I was in the Nanjing South train station. It had taken, I think, 3 years to build, and it was 20,000 jobs for the whole 3 years. And it's real, it's real steel and copper and marble and glass and electronics and escalators, and it's all real, but it's empty. I mean, there are 128 escalators, and there's very few people there. And they subsidized the train tickets, so I bought the bullet train. It goes 305 kilometers per hour. I took the bullet train from Shanghai to Nanjing, and I got out the Nanjing train. But the ticket was like $32. I mean, if you take the Excel from New York to Washington, I haven't done it lately, but I don't know. I think it's like a $300 ticket, maybe more, and they lose money. So this bullet train is amazing. I mean, it's much better than anything we have in the United States, not even close. And it's quiet and it's fast and the service is good and all that. But a $30 train ticket doesn't cover the cost. That's obviously heavily subsidized. So my point being, they build these infrastructure projects. They do import the raw materials, or they have the fabrication, manufacturing in China. It does create jobs, and they do get a finished product. That's all true. But they're white elephants. I mean, they will never repay the debt. They will never make money, and they're mostly empty. So how long can you do that before you've bankrupted the country? Well, maybe we'll find out. But I would say China is in very bad shape. Their growth is slowing enormously. Their statistics, I'm sure they overstate the growth. They're not honest about the numbers, but you can take the numbers and do some kind of mental adjustments, or taking what you know, including, for example, under general accepted accounting principles, if you build an infrastructure project and it was worth nothing, the accountants will say, well, fine, you got to write it off. You write it down to zero, keep it on your balance sheet at zero if it's not worth anything. Obviously, they don't do that in national accounting in China. But if you did, their GDP, they'd probably already be in a recession. So um, uh, that's deflationary, well, at least disinflationary or deflationary. And you look around the world, you see Europe's um, in a recession. Germany's absolutely in a recession by conventional definitions. Europe has had practically no real growth for 5 years. It goes up and down. A little bit of volatility, but um, France, Netherlands. Now the farmers are taking to the streets, or well, they're driving their tractors to The Hague and Paris and Berlin, and they're shutting these countries down because none of it makes sense. So how does the U.S. kind of prop up its headline GDP when China's slowing dramatically, Europe's in recession, Eastern Europe's in a war, et cetera? And the answer is fiscal policy. That we're piling, we're spending upwards of $3 trillion a year of deficit spending. Well, monetary policy doesn't work. I mean, monetary policy is kind of a joke, but fiscal policy can work. The question is it sustainable? If you have to spend $3 trillion of deficit spending to get $2 trillion of GDP, and those are about approximately the numbers. How long can you keep that up? Then the answer is if you have to look at the debt to GDP ratio. If your debt is going up faster than your GDP, your ratio is getting worse, which, according to a lot of great work by Carmen Reinhart and Ken Rogoff, says that you're going to slow growth even more. And the only way out of that, there are kind of four ways out: default, restructuring, inflation or hyperinflation, and growth. Well, you can forget growth. We don't have the policy set for that, and the debt to GDP ratio is too high. There's no reason for the U.S. to default or restructure, not because we print the money. Argentina has to do it. If Argentina prints pesos and borrows in dollars, they can't print dollars, so they do have to restructure or default on their dollar-denominated debt. But the U.S. debt is dollar-denominated, and we print dollars, so there's no reason to default or restructure. But you will get inflation. And I'm not saying this year. In fact, this year will probably be one of disinflation, maybe deflation. But on a longer term basis, it's the only way out.
In conclusion, Jim Rickards paints a stark picture of the challenges facing the Chinese economy, from Evergrande's bankruptcy to a housing market crash and a distressed banking sector. The decline in Chinese stocks and real estate, coupled with global trade contractions, further intensifies the economic stress. Rickards emphasizes China's strategic sale of U.S. Treasury securities, attributing it to a critical global dollar shortage. As we navigate these economic complexities, it's clear that fiscal policy plays a pivotal role, especially in the U.S. With Europe in recession and China facing a slowdown, Rickards raises crucial questions about the sustainability of current economic policies. Your insights matter. Share your thoughts in the comments below, like this video, and don't forget to subscribe for more updates on global economic trends. Thank you for watching and stay informed.